Hello, America. If you're looking for a roadmap to financial health and smart investing, remember, money meets at the intersection of Mulholland and Cooperstock. This is Mark Cooperstock, and along with my partner, Stephen Mulholland, a CFA charter holder, are the principals of Mulholland and Cooperstock Asset Management. We provide tax efficient and generational wealth management guidance while keeping a sharp eye on the economy and the markets. We'll help you navigate the superhighway of financial news and global markets amidst the daily traffic of forecasts, speculators, and prognostications. Visit our website at www.mk-am.com for more information on the firm, previous podcasts, and market commentary, and email us with your questions at info@mk-am.com. And now here's my partner, Stephen Mulholland. Stephen, what's on tap for today?
That was fantastic, Mark. Happy Thanksgiving. Happy post-Thanksgiving, everyone. We hope everyone had a great time. Mark, where were you for Thanksgiving?
Napa, California, wine country, USA.
I don't know what gets you more excited. You're always so excited to come to California, then you're always so sad to leave. Did you have a good trip?
Wait a minute, am I in some type of weird universe here?
Oh,
Trip was fine. Surprisingly, traffic was light all the way around from leaving Wednesday afternoon from Las Vegas to getting there. We flew into Sacramento and then had about an hour drive, and the airports were very quiet. The roads were quiet. Hertz had plenty of rental cars. So the 80 million people who traveled, they weren't in California.
what was your name on the board this time?
It was.
Oh, that already gets Thanksgiving started off correctly. Mark, has anyone ever told you that you'd be one of those great guys on the radio who does the traffic report?
I've been told that. I've been told I have a face for radio.
Okay, to your question, today we're talking MKAM market review. We've gotten some requests since the election in the United States. The S&P 500's had a strong year. Interest rates have been bouncing around. Mortgage rates were around 7%. We've gotten a lot of requests to talk about the market. So today is the MKAM market review. And
It's very exciting.
it, you know what? There's a lot going on, Mark.
There sure is.
So, most of our listeners, if you're an American today, particularly a Californian or a Nevadan in Las Vegas, housing is really important. So we're gonna talk about housing. We're gonna roll that into bonds. We're gonna talk about stocks, and then we're gonna talk about personally, for me, one of President Trump's new appointees that I'm really excited about, and we're gonna see if it passes the Peggy Noonan test. Mark, can you remember the name of the new, I guess recommended, not appointed yet, U.S. Treasury Secretary?
Scott Bessent.
I wonder how many of our listeners will know that name. For some reason, I can remember Besant, but not Scott. But it just goes to prove Peggy Noonan's point, which we'll get to by the end. So, listeners, I encourage you to hang to the end, and however you feel about the election, take it from Mark and I. The one segment that we know the most about is economics and finance, and when it comes to the Treasury Secretary, I think we're both really excited about Scott Bessent as the next U.S. Treasury Secretary. So, Mark. Starting on housing, what do you got for us?
So the Housing Wire is expecting home prices to increase by 3.5% in 2025. Elevated mortgage rates with inventory greater than 22 and 2023 levels will likely allow home prices to appreciate less than historically normal years. Current monetary policy by the Fed is restrictive rather than growth oriented. Elevated interest rates are a powerful factor for keeping a lid on home price appreciation in 2025. The existing home sales market is still dealing with affordability issues, which will require consistent sub 6% mortgage rates to grow housing demand significantly. Experience in 2024 shows that mortgage rates heading towards 6% can boost sales, but for consistent growth to happen, we can look back toward the early 1980s when there was a similar affordability concern and home prices didn't fall. In that era, mortgage rates fell 2.5% from extremely high levels, and that change in rates allowed home sales to grow.
So much interesting information there, Mark. So Housing Wire mentioned that it would take a sub 6% mortgage rate to grow housing demand significantly. I checked Mortgage News Daily today. The 30-year fixed average rate was 6.9. The rate has bounced between 6.11 and 7.52 year to date. Anyone who bought thinking they'd get a quick refinance, buy the house, date the rate, has been frustrated and disappointed. That 2.5% fall from the 1980s, which is coincidentally when my parents in Irvine bought their house, a fall of 2.5% sounds pretty good to anybody who bought homes in the last couple of years. But that's probably a pretty good benchmark. If we get the mortgage rate down to about 6% or below, the cohort who bought the last few years could refinance. Rule of thumb, if you can save half a point or more, it's a good time to refinance, and that would certainly get some people off the sideline. So, rolling that into this chart was stunning for listeners. You can find us on YouTube. I live in San Diego, California. Great place to vacation. The Mark, do you remember the housing and subprime mortgage bubble back all the way back that peaked in 2007, 2008?
I was a mere child, but yes, I do remember that.
You were saying Pledge of Allegiance in elementary school, right?
I
Um,
was.
so, Mark, this just blew me away. Using the Case-Shiller data, the San Diego home price, the average home price in San Diego is now 75% higher than the bubble peak of 2007. So the 2007 bubble peak wasn't exceeded until COVID 2020, right? It took from when we first moved to Oceanside, my wife met one of our new neighbors and he was still stressed. He said, I'm finally no longer underwater on my home price. It took anyone who bought a home in 2007, it took 13 years to break even, right? As long as you could afford to stay in the house. We are now 75% over that point. So, Mark, I ask you, what housing bubble?
Exactly. What housing bubble?
So,
It seems where you and I live, they're it seems like we're just used to the fact that if we want to step up, right? If we want to move to the next level, we kind of are in the same position as that first time home buyer,
yep,
right? It just doesn't seem realistic or attainable.
yep. And this was obviously something, we'll dance around it, but we won't get too close to it. But obviously, something that animated prospective home buyers in the election and that led to a lot of angst for, to your point, people trying to get on that housing ladder. I know we both have a lot of empathy. If anyone's listening, saving up to buy their first home or trying to move up, we have a lot of empathy for you here at MKAM. Uh, this San Diego price data was just stunning to me, though. Just to say it one more time, San Diego home prices are 75% above the bubble peak of 2007. Mark, welcome home. We are now talking about the bond markets.
Finally, something normal.
So we've got a couple of yield curves here, Mark. Maybe you want to talk about, I mean, to me, it's amazing. Interest rates rose from nothing to more the slope of the yield curve might not be normal, but the numbers are normal. Yet the stock market, crypto, housing has held on so strong. Any comments on the bond market year to date?
Well, the Fed was on tear to cut rates, and we saw from the 10-year, being bouncing around that 5% number, and we thought, oh, maybe that's the new normal, to dropping all the way sub 4%. I think we were 370, we were in the 370s, 3.7, 3.8. That's yield I'm talking about on the 10-year, which is the benchmark that everybody uses to compare every other interest rate to, whether it's car loan, home loan, whatever, credit card interest rates. Now we're back up to about a 420. And just when just when you thought it was safe to go back in the water, here comes Jaws again. So rates are up, and this circles back to what we were talking about 5 minutes ago on mortgage rates, right? The 30 years at a 690. We thought, okay, we're headed to 6%. We're headed to that kind of that magic floor number. We can get through it and everybody will feel good about themselves again and going out on the weekends and, raiding all the open houses and stealing the cookies on the counter. But no, it seems like people are pulling back again. So rates are where they are. I mean, we'll see what happens. The Fed keeps indicating they're going to cut. Stay tuned. We've got a big meeting announcement coming up here in about 10 days, 2 weeks.
Yep. Yeah, well said. If you want to see that 690 mortgage rate come down to 6, that 10-year yield has to go from 4.2 to about 3.2. So it's currently a spread of about 270 basis points or 2.7%. So if you for people rooting to refinance their home, you want to see that 10-year yield come down.
Yep.
Mark, I won't hold you to this, but 1 year from now, right now the yield curve's exceptionally flat. In fact, the
Mhm.
2-year at 4.2 is exactly equal to the 10-year. We've talked in a previous podcast, and I heard from listeners how much they appreciated your explanation of what a flatter inverted yield curve looks like. Um, won't hold you to it, but in 1 year, what do you think the shape of the yield curve is going to look like?
I personally think it's going to be a little more normalized.
You think the front
Um,
end will come down, the back end will go up, or
yeah, I think that just what you said. The longer you go, theoretically, the longer you go, the longer you hold a piece of debt, you should be rewarded for that. So that would mean that as you go out in time, your 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 earned interest rate, your earned return would go up. So I think it's going to normalize. I don't know that it's going to be a straight shot from here to there, but I think the first 100 days of the new administration are going to be very interesting to see what kind of policies get affected, what happens with oil, which I think is key factor into the inflation, inflationary fear, and then we'll see what happens with production and CPI.
perfect. Um, I'd be willing to add my chips to your bet. I think it'll look more normal in a year. Okay, we've covered housing, we've covered bonds. Now we're coming to stocks. This chart, which isn't too bad looking, um, shows a pretty interesting global picture of the stock market from 1986 to 2023. The weight of the S&P 500. So if you look at the total global stock market, Japan, England, France, um, Brazil, Russia, China, the United States, take up everybody, divide us in three buckets: the Americas, Europe and the Middle East, Asia Pacific. Um, the U.S. weight of total stocks grew from 32% in 1988 to 73% today. We just reached the first time in history where US total stock market capitalization is twice GDP. It's never hit that before. That's Warren Buffett's favorite indicator of the valuation of the S&P 500. As you know, Mark, there's been a lot of articles on CNBC uh, um, and comments on the channel about why does Warren Buffett have a third of his portfolio in cash. That's why. The U.S. stock market has done incredibly well. Year to date, S&P 500 is up 29%, 1 year 34%, 3 year a little over 11% per year, 5 years 16% per year, 10 years 13% per year, 20 years it's done 10% per year. That's the historical average. Anytime we always like to talk about this, but anytime you earn more than 10% per year, it's kind of like your football team that scores 40 points in the first half. They're probably not going to end up with 80, right? The S&P 500 probably over-earned a little bit of its returns. Um, what's noticeable is Asia Pacific. Mark, I thought this was pretty staggering. This was probably before you were born, but back in 1988, Asia Pacific was 47% of the global stock market capitalization. Do you see on the chart what it is today, Mark?
Uh, 9%.
47% to 9%. And Mark, you probably remember, I've read about it in books, but Japan, the Japan bubble was that, I mean, 47% to 9% on Japan bubble bursting is pretty incredible. And we're going to tease him throughout this podcast, but Scott Bessent has been investing in Japan for a long time. He's a big Japan fan, both politically, economically, and the market. It's pretty reasonable to expect some of the U.S. share to, you know, come down in the future, and a country like Japan to increase. In fact, one of the big beneficiaries, if the United States puts more tariffs on China, whose adversary, obviously, in the political military domain, one of the beneficiaries should be Japan. Japan's market is not overvalued. It's right in line with its historical averages. So we're gonna touch on this both through Scott Bessent and our expected returns, which we'll conclude the podcast with. Um, the United States performance has been incredible. Uh, we hope everyone is, we just had Thanksgiving. We hope everyone is grateful for the S&P 500 performance and their 401ks, their IRAs, and their brokerage accounts. Um, as always, it's a good time to think about diversification, adding bonds to your portfolio, looking at international diversification, something we do with our clients and in our, as we're reviewing asset allocations and how we want to set it over the next 12 months, 3 years, 5 years, 7 years, 10 years. But this graph, just kind of stunning to take a step back. So the basically the Americas is largely the United States. In 1988, it was 32% of global market cap. When we got to the dot-com peak, it got up to 53% before the crash. And today it's 73%. Asia, 47% to 9%, and Europe and the Middle East, basically about the same, 21% to 18%. I know a lot of politicians in France and the UK, they keep asking themselves, how do we get a Facebook? How do we get a Google? How do we get a Nvidia? Um, Color me skeptical. They don't have quite the same entrepreneurial culture that we do, but their stocks are a lot cheaper. And the stocks of the developed markets do belong in investors' portfolios. So, Mark, it's a good time for our do-it-yourself investors listening to look at international diversification
Mhm.
if they don't have some. Any comments from this chart?
No, I think what you said is kind of stunning. Anybody who wants to comment that, America might be, in a declining phase of our empire might want to look at this chart and reconsider.
We're the
So,
envy of the world.
yeah, yeah, no question about it. No, good job.
Enter,
That shows a lot.
good. Enter Scott Bessent.
I like
Will
his
you?
tie.
That is a nice tie. I like that. The Mark, will you give a very brief intro of who Peggy Noonan is and then read the quote by her?
Yeah, well, Peggy Noonan is a columnist primarily for the Wall Street Journal, uh, very widely respected. And her quote here is that cabinet appointees should be impressive people whose names you can't really remember.
I think that's a great quote.
What's
Scott
your name again? What's your name? Oh yeah, there you go.
and she used that in contrast, if someone gets picked for a cabinet position and everyone's like, "Oh, him," that's usually a bad sign. That if it's someone you can't really, place the name unless you're in the industry. I didn't know who Scott Bessent was until he came up on a short list for nominees. But Scott Bessent, Mark, is a really interesting guy. First off, he's the first openly gay Secretary of Treasury in American history. Um, I have to fact check it, but I see on Google that he's a Huguenot, which I find incredibly interesting, and that his family founded a church in the 1600s in South
Huh.
Carolina that he still belongs to. Um, he's
He
just a
was
really,
also the former CIO, Chief Investment Officer for George Soros,
well, that's the more
but that's
relevant
about
part.
about 15 or 20 years ago. So,
So, Mark, a lot of people know, but just in case they don't, so George Soros made his career, and I'm going to completely leave out any political commentary on George Soros. As a financier, he's an absolute legend, thorn in the side of the Bank of England, but he made his career betting that the UK couldn't maintain their peg of their currency to the Deutschmark. And George Bessent was a young analyst for George Soros at that point in time. And Mark, there's a fascinating interview that Mr. Bessent gave, I think it was about a year ago in New York, where he talked about his insight for why he and this was his contribution, why he and George Soros were so confident that the Bank of England wouldn't be able to maintain the peg of their currency to the Deutschmark. And he said in England at the time, very different from America's mortgage system, that every time the Bank of England changed their interest rates, that every homeowner's mortgage rate was repriced that Friday. So it was, they were every mortgage in England was a floating rate mortgage loan, and they would have to be repriced every Friday after the Bank of England raised rates. So their strategy was to attack the British pound, make it go down in value, and the Bank of England at first would raise rates, right? The higher the rates are, the more foreign savings you attract, the more people buy the bonds. That usually strengthens the currency. Their bet, one move. So the Bank of England had a very first order, strategy. Their bet was that the Bank of England wouldn't be able to take enforcing that much pain on the average homeowner in England. And in Germany, it's a renter society still to this day, where people rent their homes rather than buy. But England, after the Thatcher Revolution, became a huge home ownership society like the US. So their bet was, as the Bank of England raised rates to fight Soros's hedge fund and Besant and Jim Rogers in weakening the currency, that eventually they would give up because the homeowners would be so upset and politically it would be untenable for the Bank of England. So he said there was some pain, but they kept at it with their second order reasoning. And they said the moment they knew they won is when the Bank of England made their last hike and the currency didn't appreciate, it fell.
Hmm.
So um, the trade was wildly successful. The Bank of England probably still hates George Soros. I think everyone in England knows who that's what they think of when they think of George Soros. Very smart analysis, very profitable trade. And to have a guy be the Secretary of Treasury who knows, who clearly shows creativity, original thought, who knows how foreign exchange markets work. He's worked in detail. That was a bit adversarial as a hedge fund for the Bank of England, but he's also worked cooperatively with the Bank of Japan. He knew a former Prime Minister Abe very well. Um, to have someone like this at the Treasury, I just think America's very lucky.
Well, a quick comment. I mean, clearly, Mr. Besant doesn't work for Mr. Soros and hasn't for quite some time. And Mr. Soros has a very different reputation in this country for a variety of reasons. But how much do you think it pains George Soros to look at that picture of Scott Bessent standing in front of a Trump Vance podium sign? I mean, maybe that's Scott Bessent's ultimate dig back at George Soros. Here I am. Look at me.
I picked that picture just for you, Mark.
Okay, there you go.
Um, so by the way, and as a financier, I'm a huge fan of George Soros as a financier. But so I fair point, Mark. But I'll stay away from the. We'll keep moving along on Besant. It is a great picture of him though. Besant's plan, echoing Ben Carlson and Abe's three arrows. Have you heard of Scott Besant's 3-3-3 plan? The three threes.
Yeah,
Okay. Do you want to try to guess the three?
3% inflation, 3% growth, and 3%. It's not unemployment.
Well, it's interesting. You're right.
3%. Yeah, go ahead.
They'll take 3% inflation, but officially it's 3% GDP growth, 3% budget deficit,
Right,
3 million more barrels of oil. So
right.
just to hit those three real quick, and maybe this goes to um, with the caveat that this guy works at the pleasure of the president, and he will be constrained by what the Federal Reserve does and other goals and appointees of President Trump. Looking at just Besant's plan, 3% GDP growth. Under Bill Clinton, George Herbert Walker Bush, George W. Bush, um, Donald Trump, Joe Biden. For 30 years, the U.S. has grown at about 2% real GDP growth pretty consistently. Besant wants to dial that up from 2% to 3%. He wants to get the budget deficit from around 7% down to 3% by 2028. And then America produces about 22 million barrels of oil per day. He wants to add 3 million barrels. That's about 14%. In the University of Michigan surveys, where they poll voters about a poll when they poll individual Americans about inflation expectations, the number one driver is energy and gas prices. So to your point about inflation, their bet is that if they increase energy production, bring gas prices down, that'll bring inflation expectations down. And inflation, much like financial assets, is very cerebral. Its expectations can inform outcomes. So part of why they want to get energy production up is to get inflation expectations down and make sure that Paul Volcker had to kill inflation on the way towards the Reagan Revolution in the 80s, really strong economic growth for the US. We just had our first bout of inflation since then. Besant and the future Fed chair, probably Kevin Warsh, and Donald Trump will want to make sure inflation stays in the rearview mirror, stays a post-COVID phenomenon. So what else will increasing energy production do? It gives the United States more diplomatic political flexibility. Let's say Iran's oil production was taken offline, but the U.S. is producing more energy. That also helps from that aspect. It also helps boost domestic GDP growth. We talked about trying to get to 3% GDP growth. A lot of the headlines are about tariffs. Scott Bessent's position on tariffs are that they're a way to escalate to de-escalate, that by putting on tariffs, tariffs are the stick that we tried the most favored nation status with China, where we said, you can do whatever you want. You're our best friend. We'll open our markets to you. And it created an incredible trade deficit for us, trade surplus for China. Um, so that was the carrot. The tariff is the stick. So Besant's a fan of using the tariffs, not for tariff's sake, but to rebalance some of these imbalances. I was just looking at some of the numbers, but if you take what America's GDP is in a given year and you boost the growth 1% from 2% to 3%, if you keep spending on the economy, on the budget, if you keep spending on the budget relatively flat, that extra percent of growth over 4 years, what does it bring the budget deficit of 7% down to? 3%. So it's not overnight. It takes time, but the 333 plan is credible. Besant talked about that in a video interview. He talked about it in his most recent hedge fund letter. To your point, he was the CIO of his own hedge fund, Key Square, after he was previously the CIO of the Soros Foundation. I'm guessing to your point, those discussions must have been interesting between the Soros Foundation and the investment officer of the Soros Foundation. But yeah, he talked quite a bit in the letter and the video on this 333 plan, and it'll be really interesting. I really hope he's successful. They're going to try to go slow. And you mentioned something earlier. For 30 years, we had 2% GDP growth and about 2% inflation. Mark, do you remember the days when the Fed worried that inflation was too low? How do
Yeah.
we, right? It seems like a long time ago, but pre-financial crisis, that was a real big concern, at least for the people at the Fed. Um, what is the inflation for developed markets, including the US? Throughout modern history, it's 3%. I think Scott Bessent and Donald Trump would happily take the inflation rate you mentioned of 3%. So 3% inflation instead of 2%, 3% real GDP growth instead of 2%. That's it might not sound like much, but 3% versus 2%, that's a pretty big step change in growth. And anyway, so I thought the 333 plan was very interesting. Besant is obviously really savvy in the financial markets. We'll talk more in our future MKAM market reviews, but I'm really excited about this Treasury pick.
Well, I'll tell you, we spent a lot of time talking about him. I hope he gets confirmed. Otherwise, stay tuned for a quick podcast.
Oh yeah, and I was talking with my wife on um on why Trump picked Basent, and I think it's also fair to point out, and I think it goes to his shrewdness. He was also one of the larger donors to Donald Trump. So, being a true financier, he had a strategy. Let's say he really wanted this job, and to your point, I hope he gets picked.
Yeah, no, he's a smart guy.
Yeah.
Okay.
Mark, my favorite graph that's obviously confusing for other people. The expected returns, bills, bonds, and stocks. So this is from a great book, Triumph of the Optimist, which for some reason, and it's endearing, my dad always changes the title to Revenge of the Optimist. Um, when Dimson and Marsh and Stanton, London Business School, where my brother went, published Triumph of the Optimist, what they were trying to do is show stocks win for the long run, and they have in developed markets across the world. So if you looked at Holland or France, the UK, the US, Australia, stocks have tended to go up in nominal terms about 10% a year, right? Um, and historically, bonds have gone up 5% a year, and bills, bonds that are due for 3 months, for example, have generated about 3.7%. At the end of 2021, coming out of COVID, the world was pretty unusual, right? Treasury bills were paying 0.1%, nothing. That's why cash accounts paid nothing. 10-year bonds were paying 1.5%. And US stocks looked pretty expensive and offered pretty weak returns. The world's pretty different now. Um, Mark, bills today at 4.5% pay even more than the historical average, right?
Yep.
In bonds, compared to the historical average, we're not too far off.
No, no, no. It's probably pretty close.
And the one outlier,
Well, there you go.
so US stocks, Mark,
Stocks again. Yeah.
for this chart, just to be sort of unbiased, we use Vanguard's expected market return. Anybody can go on their website and check. Their forecast for the next 10 years is an annualized 4%. So that's a lot lower than 10%.
Yep.
And that's nominal, right? So, and interestingly, in their most recent forecast for the rest of the developed world, including Japan, the UK, France, Australia, their expected return is 8%. 8% is a lot closer to 10. Just to underscore the point again. Oh, and Mark, 10-year bond yield, which to your point, if you buy a 10-year bond today, on the run, you buy a next 10-year US Treasury that's paying 4.2%.
Mhm.
What will your return be in 10 years?
What will your return be on
You buy a
on the
new
10-year?
bond. Yeah, you
Hmm.
buy a new bond. It comes due in 10 years and it pays a
Right.
coupon of 4.2%. What
Right.
will your 10-year return be per year?
4.2%.
Bingo. When you buy stocks, they can go up.
I thought that was a trick question. I'm like, wait a minute.
It's a trick question. It's a trick question only in the sense of that's a guaranteed 100%,
Right.
no volatility. You can take it to the bank, 4.2%. That's higher than Vanguard's expected return for the S&P 500, which is anything but guaranteed, right? So having some bonds in the portfolio makes sense. If
I've
you're
been
an investor,
saying that for 40 years, Stephen.
hey, everything cycles, right, Mark? You're back in vogue.
So it's a 40-year cycle.
There it is. Um, If you've reached your investment objectives and you're feeling grateful for how much your stocks have gone up, take a look at this chart. Take a step back. Probably a good time to at least rebalance and buy some more bonds. If you're young, if you're growing, if you have higher risk tolerance, really consider, even though they've underperformed, that's the reason they have twice the expected return stocks in Japan and in the rest of the developed world.
Yeah,
Um,
coming back for a quick second to what you just said. When I first got into this business 40 years ago, um, one of the mentors, if you will, the old timers in the office said, "It's not really a gain until you take it as a gain."
mm,
So, if you, to your point, if you're sitting on some nice fat returns, it's okay to take a little off the table and reallocate that, right? Because your whole goal was to make it. And if you don't take it, you really haven't made it till you take it. You can quote me on that.
That that's a
I don't think I could say it again, but you can quote me on that.
that is a perfect close, Mark. Do you have any parting thoughts for our listeners?
No, stay tuned. We're in some really interesting times. As we're recording this podcast, it's December 4th. We'll see what the next 4 to 6 weeks holds. We've got Federal Reserve action. We're going to have, a new administration, and we'll see what happens as we move forward here over the next 6 weeks, 90 days, and 6 months. It's going to be very interesting times that we're in.
Excellent. And listeners, all of you, we have heard your request for more frequent podcasts, and we promise to deliver these MCAM markets in interesting times more regularly.
You got it. Remember the opinions expressed on this podcast are those of the hosts and any guests that we might have. Nothing discussed today should be considered investment advice, and please consult your own financial advisor and tax advisor whenever considering any type of investment. If you have any questions and you're one of our clients, please email us with the term podcast in the subject line. For more information about this podcast, the hosts, and our firm, visit us at www.mk-am.com or email us at info@mk-am.com. Thanks for joining us. Steve, always a pleasure. And look and listen for our next podcast release in the very near future.
Happy holidays.